Tax planning is such an important tool, and I see that all the time. And the reason I talk about tax planning is because most people, most business owners, most individuals, they come to me for tax resolution on issues that if they had planned it better, they would have avoided a lot of taxes. Tax planning is something for small businesses. I tell you have to start your tax planning from the start of the year. At the beginning of the year, you have to be talking to your CPA on a constant basis so that he knows what you're intending to do. He will tell you what to do that will be tax beneficial to your business. There are small things that you can do for a business and it will give a huge tax benefit. And dates are very important. That is why you want to speak to your CPA before the end of the year, before you make some significant payments, before you make some significant transactions, because those transactions are things that he can use to avoid taxes. They are things that we call tax deferral tools. They help you defer some taxes. They help you avoid some taxes now and in the future. They just help you avoid those taxes altogether. So it is important to talk about tax planning. Tax planning is the most important tool for any businessman. That is why when we talk about all these Elon Musks, we talk about all the Jeff Bezos, we talk about the Donald Trumps, all these guys, they don't pay taxes. When Donald Trump was in power, everybody said he wasn't paying taxes. Why doesn't he pay taxes? Because he's using the right people, he's doing tax planning, and he's able to avoid taxes and carry significant net operating losses that he can use against future income. In the 1990s, Donald Trump had tax losses close to $1 billion. When you have $1 billion of net operating losses, it means that for the next 10 years, 15, 20 years, for someone who is making millions and millions, he's not going to pay no taxes. Because he's going to use those operating losses and wipe off any income that is coming through. And that is what happened. It is planned. You have to plan it. And you have to invest in the proper way. Invest properly. You could make $1 million now, and the year is about to end. You come and see me and say, Charles, I made $1 million in income. $1 million in income, you're going to pay about 50% of that money in taxes. Maybe more than 50, maybe 60% of that money in taxes. But I could help you. What I can do is, basically, I can help you. We can just decide to go and buy one of those equipments that you need. And then we use it on a section. There's something we call Section 179. You just go out there, you have good credit, you go and buy something. Once you buy that thing, you didn't even pay a dime on it. You went and bought some equipment for $1 million because you have $1 million net profit. You buy that thing for $1 million. You didn't pay nothing for it. You just went and they signed the agreement and it becomes yours. You can basically take that $1 million and wipe up all that profit with. You see yourself getting a refund instead of paying a tax on that $1 million. It is more for businesses. And I'm going to tell you about something. America, the way America is structured is really, really specific. You know, in our country, in this country, there are 4 sets of people, 4 sets of taxpayers. There are 4 different types of taxpayers in America. The first set of taxpayers is employees. Employees pay taxes of up to about 50-55%, especially when you're a high income earner. Because first of all, the IRS actually takes its money before you even get yours. So employees are the most vulnerable part for taxes. The next set of people is what you call entrepreneurs. So those who have started, they are entrepreneurs, they're trying to build something. So you get to pay taxes. You are able to avoid certain taxes, but you still get some significant taxes, which is called self-employment tax. So you just started trying to move away from that supernatural excessive taxes, but you're still in that category where you still get to pay a lot of taxes because you're paying something called self-employment tax. Then next, you want to quickly run away from that and become an organized business, what I call formal business. Once you are a business, there are lots of things that you can take out of there. First of all, if you're structured and you elect properly, you file your taxes and you can avoid most of that 15.3% of self-employment tax just because you're structured properly. That is the third group, which is businesses. Businesses pay just 21% in taxes. So you just moved away from paying 50% plus 14 point something percent. You're now paying just 21% in taxes. And after you pay those taxes, after you've reduced all your expenses, as a business. So you see that you're going to that place where you have a lot of opportunity to optimize your taxes. Then the last portion is where you become an investor. You're that huge real estate investor. That is what some of these big boys, they do. They are all in that space where they are investors, and they are able to take a lot of benefits in terms of depreciation, cost segregation. They are able to take all sorts of benefits that will avoid them paying taxes. Most investors, they pay 0 to 5% in taxes. Nothing, almost nothing. And some of them keep getting refunds, even though they are making big money. Because what do? When I use other people's money, I take a loan, I buy something. That loan, I take it and I write it off immediately. And I don't pay no taxes. Just the bare fact that you're using other people's money in building business, it makes you pay no tax. So that is the different structures, 4 different structures. Employees, entrepreneurs, businesses, and then investors. And you want to go from employee quickly to entrepreneur, from entrepreneur quickly to a business, and from a business you go down to what? To an investor. And when you are an investor, you are in the El Dorado of taxes.